95% of traders lose money. You've heard it 1,000 times. And the guy telling you that, he's about to sell you his $997 course so you can be in the 5%. Here's what they don't tell you. The reason the vast majority of traders blow their accounts has almost nothing to do with their strategy. You could give a losing trader a strategy that wins 70% of the time, and they would still find a way to lose everything. We are throwing out the marketing BS. We are looking at the raw data, the market structure, and human psychology. We are going to show you the 3 actual reasons traders lose, reasons no guru will talk about because it kills their business model. By the end of this video, you'll understand exactly why you're losing, and more importantly, how to stop. First, let's clear the air on that 95% number. It's a myth. According to legally mandated regulatory filings from major brokers, data they have to report to the government, the real number is between 70% and 80%. But let's be real, 80% is still a bloodbath. 8 out of 10 people who open a trading account will lose money over a 12-month period. So why? Are they all just stupid? Do they just not know what an RSI divergence is? No. The first real reason is purely mathematical. Most traders are mathematically doomed before they even place their first trade. It all comes down to something called the drawdown hole. Let's say you have a $1,000 account and you lose 10%. You now have $900. To get back to $1,000, you don't just need to make 10%. You need to make 11.1% because your base is now smaller. Now, let's say you lose 50%. You have $500 left. To get back to your starting point, you need a 100% return. You have to double your money just to break even. Retail traders risk way too much per trade, 5%, 10%, sometimes their whole account. They don't realize that even the best trading strategies have losing streaks. It is mathematically guaranteed. If you risk 10% per trade, a string of 5 losses drops your account by 50%. You are now in a mathematical hole that requires a miracle to climb out of. The 5% don't have better strategies. They just manage their math so they survive the losing streaks. Reason number 2 is structural. You are playing a game where your opponents literally use your money to win. To understand why retail traders lose, you have to understand institutional order flow. Banks and hedge funds need to buy and sell massive amounts of currency or shares. They can't just click buy without moving the market against themselves. So, where do they get their orders filled? From retail traders. Retail traders are taught to put their stop losses in the most obvious, predictable places, right above a swing high, right below a swing low. These zones become massive pools of pending orders. Institutions push the price into these zones, trigger your stop loss, meaning they are buying the contracts you are forced to sell. And then they move the market in the real direction. You didn't lose because your analysis was wrong. You lost because your stop loss was the fuel the market needed to go where it was going anyway. You aren't a trader. You are the liquidity. The 5% don't put their stops where everyone else does. But even if you fix your math, and even if you understand liquidity, reason number 3 is the hardest to beat. Your own DNA. In 1979, psychologists Daniel Kahneman and Amos Tversky proved something called loss aversion. They proved that the psychological pain of losing $1 is exactly twice as intense as the joy of gaining $1. This was great for keeping our ancestors alive 100,000 years ago. Don't lose your food, or you die. But in the markets, it is a death sentence. Here is how it kills you. The moment a trade goes into profit, your brain feels anxiety. What if it reverses? What if I lose this green number? So you cut the winner early. You secure the tiny profit to feel safe. But when a trade goes red, the brain panics. I can't take this loss. It will hurt too much. So you hold it. You move your stop loss. You average down. You turn a small planned loss into a catastrophic, account-killing blowout. Retail traders cut their winners short and let their losers run. It is human nature. The 5% don't feel less fear. They just have systems to override it. So why won't the gurus tell you this? Because fix your risk management, stop being the liquidity, and overcome your human psychology are terrible marketing. They can't put that on a sales page. They need you to believe the problem is that you don't have their secret indicator. Because if the problem is a secret indicator, they can sell it to you for 3 easy payments of $299. If you want to survive, you have to attack the 3 real problems. 1. Risk 1% or less per trade. Make it mathematically impossible for a losing streak to put you in the drawdown hole. 2. Stop placing your stop losses at the obvious swing highs and lows. Stop being the fuel. 3. Write your rules before the market opens and execute them like a machine. Stop trusting your feelings. The market isn't rigged against you. It just doesn't care about you. If you want to win, you have to stop playing the game like the 80% and start thinking like the 5%. If this video made you rethink your trading, hit that like button. Drop a comment below telling me which of these 3 reasons you struggle with the most.